You watch your screen as the red numbers drop. Years of hard-earned savings vanish in a matter of hours. The panic rises in your chest like a physical weight. Someone or something needs to take control of the wheel. The survival of your wealth depends entirely on your next choice. There is a silent war happening in the financial world. It is a battle for control over your life savings. On one side stands the cold precision of automated algorithms. On the other side stands the experienced human mind. We now rank the 3 ultimate portfolio managers. We will reveal exactly who deserves your trust. The data exposes truths that Wall Street rarely talks about. The cheapest option often carries a hidden, devastating cost. We begin with the most independent path available to modern investors. Do-it-yourself investing relies entirely on your own discipline. The appeal of this method is rooted in pure math. You avoid paying advisory fees to an external manager. You only pay the expense ratios on your chosen index funds. A basic 3-fund portfolio captures the global stock and bond markets. This simple strategy costs as little as 3 basis points to maintain. You keep almost every dollar your money actively earns. Over 20 years, this compounding effect builds massive wealth. You maintain absolute control over every single decision you make. DIY investors learn quickly that picking individual stocks is a losing game. They turn to passive index funds instead. The data proves that passive investing beats active management over long horizons. Scorecards show that most active managers fail to beat their benchmarks. Building your own passive portfolio is statistically sound and highly efficient. You cut out the middlemen and their expensive, unnecessary management fees. The barrier to entry has never been lower for the retail investor. But the fatal flaw remains your own emotional reaction to market volatility. This ultimate control is exactly where the greatest danger lies. DIY investing requires you to act as your own behavioral coach. You must suppress your natural instincts during terrifying market crashes. Most people fail this psychological test when their money is burning. Studies show the average equity investor dramatically underperforms the market. They buy during euphoria and sell during sheer panic. This behavior is driven by a psychological bias called loss aversion. We feel losses more acutely than the joy of a win. Without a coach, investors abandon their strategies and destroy their own wealth. They forfeit years of compounding returns because of unchecked anxiety. This leads us to the next evolution in modern portfolio management. Robo-advisors emerged as a brilliant solution to human emotional failure. These digital platforms use algorithms to build and manage your portfolio. They charge a fraction of the cost of a human advisor. The median fee for a robo-advisor is roughly 0.25%. For this low fee, the machine automates your entire investment process. It rebalances your assets automatically to maintain your exact target risk level. It methodically sells losing investments to harvest valuable tax deductions. The algorithm never panics, never hesitates, and never trades based on fear. Robo-advisors use fractional shares to put every penny to work. There is no idle cash sitting around losing value to relentless inflation. The tax loss harvesting feature is extremely difficult for a human to replicate manually. The algorithm scans your portfolio daily for opportunities to offset taxes. It sells a losing position and replaces it with a similar asset instantly. This automated precision can boost your after-tax returns without any effort from you. Yet, if the market crashes and you hit the withdraw button, the machine simply obeys. It does not ask about your long-term goals or your retirement dreams. These digital managers have a severe limitation when life gets complicated. They cannot talk you off the ledge if you decide to withdraw your money. A machine cannot look you in the eye and understand your personal fears. It cannot coordinate your investments with your estate plan or your tax strategy. When your financial life involves businesses, inheritances, or complex family dynamics, the algorithm breaks down. This brings us to the highest ranked manager for building long-term wealth. Human financial advisors represent the most expensive option on the market. They typically charge a median fee of 1% of your total assets. People used to assume this fee paid for superior stock picking, but the data shows that actively picking stocks usually fails to beat the market. The true value of a human advisor comes from a completely different source. It comes from a revolutionary concept known in the industry as advisor alpha. Vanguard researchers quantified the exact value of wealth management best practices. They found that a good advisor can add about 3% in net returns. This extra value completely offsets the 1% advisory fee over time. The biggest component of this value is behavioral coaching during market distress. An advisor acts as an emotional circuit breaker when widespread panic sets in. They prevent you from selling your assets at the absolute worst possible time. This intervention can save a portfolio from catastrophic, permanent loss. Human empathy is a differentiating factor that no algorithm can ever replicate. Beyond behavioral coaching, human advisors optimize the hidden mechanics of your wealth. They manage your asset location to drastically reduce your lifetime tax burden. They place tax-inefficient bonds in sheltered accounts and tax-efficient equities in taxable accounts. This highly personalized tax strategy can add up to 75 basis points of value. When you reach retirement, they sequence your withdrawals to minimize your tax hits. This dynamic withdrawal strategy can add more than a full percentage point of value. A human advisor coordinates your entire financial life across multiple complex dimensions. For truly complex situations, a dedicated human advisor remains the ultimate standard. When your net worth crosses a certain threshold, the stakes become infinitely higher. A mistake in estate planning or tax sequencing can cost hundreds of thousands. The human advisor builds a relationship based on trust and mutual understanding. They protect you from the relentless noise of the financial media. They remind you of the customized plan you built before the panic started. The advisor earns their fee by managing the 90% of your financial life outside the stock market. The ultimate portfolio manager is not the one who picks the best stocks, but the one who protects you from yourself.